Hi everybody, Sheena Hansen here with our frequently asked questions series, and today I come to you with a topic regarding retirement account contributions. This is one that I get a lot. Should I be contributing to my 401k or my IRA on a pre-tax basis, or should I be making Roth contributions? And just a reminder to everyone, it really is all about taxes. Pre-tax means that you don't pay taxes on money going into that retirement account now. You defer that into the future. Whereas Roth contributions, you pay income taxes now, whereas you don't pay any taxes down the road. So let's dive into it. I'm going to start with a few examples. One being where an individual's tax rates stay the same between now and in the future. The second one being where there's a tax rate decrease. And then the third one where that individual has a tax rate increase. So this example clearly demonstrates that if your tax rate stays the same now and into the future, it really doesn't matter how you contribute. You can contribute pre-tax, you can contribute Roth, and if your tax rate stays the same, your financial situation is going to stay the same. This individual made a $1,000 contribution, this is for illustrative purposes, to a Roth account and also to a pre-tax account. You can see off to the right there that the Roth contribution, you pay taxes now at the rate of $250. And then over 20 years, assuming this investment grows by 500%, those investments grow, the balances grow, and then when the money comes out, the pre-tax account, you owe taxes at that time at a rate of $1,250. The Roth distribution is $0. It's tax-free since you've already paid it, but yet the final after-tax value for the same tax rate situation of 25% is the same. In both circumstances, the after-tax value is $3,750. Let's take the example of a future tax rate decrease. So to keep things simple, the same contribution amount, $1,000 into a pre-tax account, $1,000 into a Roth account. That Roth account pays taxes now. Both accounts grow at a rate of 500% over 20 years. And then when money gets pulled out of those accounts in the future at a decreased tax rate of 15%, well, the final after-tax value is very different. The pre-tax account is at $4,250, whereas the Roth account is less, $3,750. So in this situation where an income tax rate is expected to decrease in the future, then you're going to be better off making pre-tax contributions when you're at a higher income tax rate. Let's see what happens when the situation is where there's a future tax rate increase. Well, you probably could have guessed, but let's go through this one more time. $1,000 contributed to a pre-tax account, $1,000 contributed to a Roth account. Today's tax rate is 25%. That Roth account tax gets paid now. The growth on those investments is 500% over 20 years compounded. And when that money gets withdrawn, there is an increase in tax rate by 35%, and those final after-tax values are different. $3,250 for the pre-tax account, $3,750 for the Roth account. So here we can conclude if you expect your taxes to be higher in the future, then you're going to be better off making Roth account contributions today. So there's a couple of ways that we need to interpret this before we make a final decision on pre-tax or Roth contributions, or maybe even a combination of both. What are current tax rates? Are you in a high tax situation, or are you in a low tax situation, or maybe somewhere in the middle? And then also on a very personal basis, for you, based on past trends and what you expect for your future income to be, what does that look like? Are you in a low income year or a high income year? And base contributions based off of your situation. So, this picture really illustrates a starting point, as I say, for helping on that decision. The blue buckets there, the 32%, 35%, 37% income tax brackets, those are high tax brackets. People who are in those rates, they need to be avoiding income and taking those tax deductions now. And so for people in those higher rates, usually pre-tax contributions are better. For people who are in lower marginal rates, 10%, 12%, 22%, you might consider Roth contributions because you're in a lower rate today. Why not realize that income, pay that tax so you don't have to worry about it in the future? As we turn it towards your personal situation, this is kind of a nice matrix that takes into consideration current rates and also future tax rates to really drill down on even more. If your current tax rate is high in terms of the marginal rates and also high in terms of your income rhythm, I should say, is it a high income year? I think, again, that points to contributing to a pre-tax IRA or a 401k if you're definitely in those high marginal rates and you're having a high income year for you. Now, if your current tax rate is low in terms of looking at the marginal rates, and you personally are having a lower income year, that would point to making Roth contributions. Pay that tax now. Now, also thinking and fast forwarding to the future, we can make assumptions, although we don't know for sure where future tax rates will be on a marginal basis. I feel like we can turn inwards to our situation and make a little bit better assumptions to what our income situation might look like. So if you're young and you're growing in your career and you expect your income to go up over time, I think that would be a pretty reasonable assumption. Another common situation I can think of is someone retiring. Maybe they are 61 years old, they're in some of their peak income years, and they're planning to retire next year. Well, I think that individual could anticipate a decrease in income, their future income. So thinking about our future tax rate, if we think our future tax rate is going to be higher than it is now, I think you can draw the assumption that maybe doing a Roth IRA or Roth 401k would be best. And on the flip side, if you expect your future tax rate to be lower, like that retirement example that I just gave, that means you can probably assume and maybe point to doing pre-tax contributions now. So that's it in a nutshell. Again, it really comes down all to taxes, and taxes in a couple of different ways of thinking about it. Where are you falling on a marginal tax rate? And where are you at with your personal income, and what can you expect it to be in the future compared to what it is now? If you need help kind of figuring out your 401k contributions on a pre-tax or Roth basis, please get in touch with our office. But otherwise, I hope this was some good education and helps you make better decisions.